do the chapter 5 and 6 handout. I'm combining chapter 5 and 6. We're not going to do too much in chapter 5, and I'll tell you why in a moment, but they kind of go hand in hand. Chapter 5 is time value of money, and chapter 6 is revenue recognition, which we need chapter 5 for some problems. So anyway, let me put up my blah 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 blah. There we go. All right. Now, those of you that had me before have seen the first couple pages here. They're strikingly similar to what I have in accounting 111, but the idea is the same. It's present value of money. Now, there's two different things. There's present value of money and there's future value. For accounting, and actually for most things, present value is by far the more important because it puts money into today's terms from the future. So, and we live in today, we make journal entries today, so this is why the present value is usually much more important than the future value. Future value is when you want to calculate how much your, say, investment is going to grow to, which is fine. But you got to remember that, going into the future, those dollars are worth a different amount. So if you say, okay, I want to have, whatever. So, well, future is definitely important for some things. For what we're doing, and usually for decision making, present value is the one that we're really looking at. Whereas future value is more for planning on things rather than making actual decisions for today. Okay, so let's take a look here. Present value of money. Grandma, so the first couple pages here are just kind of going into the present value of money stuff. And we're going to use tables. We're going to use tables for a couple of reasons, but probably the most important one is when you take the CPA exam, they usually give you factors from tables. So you say, well, I can do it on my calculator. Not on the CPA exam, you can't. And you can do it in Excel, it's true, but a lot of times, again, on the CPA exam, they're going to give you just the table to do it. They do allow you to use Excel type spreadsheet program on there, but you're just going to go ahead and do it. They're going to give you these the things from the table. So anyway, that's why we're using the tables. If you're wondering why we don't use the calculator, that's why. All right, single payments. Grandma promises to pay her grandchild $1,000 in 3 years. What a cool grandma. What is grandma's gift worth today? Okay, the table we're going to use is a single payment. She's just going to pay us one time, or whoever, I guess her grandchild, at one time. Her discount rate is 6%. Oops, try that again. And the number of periods is 3. Okay, now going into the future, dollars we receive in the future are not worth as much as today because of inflation. And you hear your parents talk about how they went to the movies for $1 or something like that. Well, that dollar was worth a whole lot more back then because of inflation. So what we're going to do is go to our table and we're going to find our factor. So let's see, this is 3 periods. Let's make it green. Can you see green? Blue? I don't know. We'll do the blue. 6%. Okay, so We're gonna put the amount in here. We're gonna say 1,000 times, and then this is our factor. Now this factor, oops, this is for each dollar. So each dollar, 6% 3 years from now is gonna be worth about 84 cents. So grandma's gift today is worth $840. So this is the time value of money. So this is bringing this money back to today. Just see what it's worth. Yeah, I'm sure you guys had this in other classes too. So, any question on that? Good. Let's go to the next one. Grandma promises to pay her grandchild $1,000 in 5 years. Single payment. The rate is 10%, and the periods are 5. Okay, so we're gonna go back to our table. 5%, scratch that. I'm sorry, 10% for 5 periods. So 621. And so that's in today's dollars. Okay, so this is for single payments. And you'll notice something. I have to zoom out too far here to make it, I don't know if you guys can see that or not still. Anyway, you'll notice that grandma's $1,000 gift is worth much less in number 2 than it is in number 1. So they're both $1,000 gifts. Why is the second one worth so much less?
Was the money's worth less every year?
Yes. So the more years you go on, if you go down the list here, if you see the number of years, as you go down the years, you'll see it gets less and less and less. The further out you go, the less it's worth. Also, if you look at the time value of money, this is sort of like inflation. It's going across the top. As the interest rate goes up, it becomes less and less. Now, the higher the interest rate, the less it's going to be worth in the future. So this one actually has two things going against it, and that is longer time period and the interest rate is higher. So even though it's the same $1,000 gift technically, where it's given and the rate it's at and all that makes a difference as far as what it's worth. Okay, annuities. Annuities are very common in, well, just in everyday life, but also in business. And just in a lot of things, like for instance, your rent, is the same amount every month. That's an annuity. Here, if you have a mortgage, it's the same amount every month. It's an annuity. There are a lot of things that are the same that fall into this annuity category. Now, present value for a single payment, you can always use that table. You can always use a single payment table. And let me let me put in the numbers here and then I'll show you what I mean. Oops, where am I at? Okay, let's try this again. There we go. Okay, so Uncle Fred promises to pay us $1,000 at the end of each year for the next 5 years. Now, we could go to the single payment table and say, okay, how much is this year one worth? You know, it's like we did up here. You know, we can go to year one and how much is year one worth and year two and so on. We could do all these individually. We could do 7 calculations of this, right? And do it on a single payment table. However, the annuity table is very helpful because it'll actually add up all of the all of these single payments, add them all up and multiply them just one time. And let me show you what I'm talking about here. Okay, so Fred promises to pay his nephew $1,000 a year. Table, this is going to be an annuity table. They're all the same payments. We can use the annuity table. The rate is 6%. The periods are 7. So we're going to take 1,000. That's how much each of the payments are. Times, see, 7 periods. Yeah, let's go turquoise. 6% is 5.582. Hey, what happened there? Okay, 5,582. And again, this is just all of the 6% single payments added up. And I'm sorry for my formatting. I will leave it here. All right. And here's what I'm talking about. If I go up here to, was that 6%? I think it was 6%. Okay, if I go up to 6%, if I take all of these, I'm going to plug them into a cell just to make it. $5.582. Is that what we had? I think that's what we had, isn't it? Nope, nope. Yeah, 5.582. So, you know, if you're wondering where that 5.582 comes from, it's simply taking all those. This is off the single payment table and adding up all those years. So, you know, this would be the same as saying 1,000 times this. Oops. You know, all the way down. Or you could just do it one time. And this is what the annuity uh, table does for us. So it just adds all these up. So we don't have to do each of these individually. Well, we could. It should come out the same. It might come out a little bit sometimes because of rounding, but it should be pretty much the same. So you could use a single payment table, do 7 calculations, or you could just use the annuity table. So that's why we use the annuity table. It's just faster. Okay, enough of that. Oh, no, not enough of that. Janet wins the lottery. Everyone in her family quits working. The money to be paid out at a rate of $100,000 for the next 20 years. The discount rate is 8%. What is the lottery worth today? Okay, so it's going to be an annuity. We could do the single payment table. It would be no fun, but we could do it. Number of periods is 20. I didn't do all the way through to 20. It's I'm just gonna put what 100,000. Let's put 100K in here. Oop. So Janet's gonna get $100,000 for the next 20 years. Okay, so I'm gonna do 100,000 times, let's see, 20 periods. What was the rate? 8. 98, 9.87, 9.817. Nope. So this is what her winnings are today. So if I know when you win the lottery that they do you want to take it in a lump sum or do you want to get the annuity payments? And if you take a lump sum, that's what you get today. And by the way, the state will give you, say you want a lump sum, or you can also shop around to see if someone else will give you a better deal. And the better deal would be, is you'd want to have a lower discount rate. The lower that they have the discount rate on it, the more money you would get. So if you found someone that would pay you at 4% rate, that means that you would get 1,359,000 something, something, something. Okay, question on that? All right, well, let's jump into our problems. Some of these will have to do with it, some of them won't. Scratch that. I'm still in chapter 5. I was thinking of going to chapter 6. Okay. First of all, any questions on pages 1 and 2? Any questions on those? I know you guys probably. Yeah,
The only question I have is like, I know the rate is given,
yeah.
but in cases where we might have to figure it out, how is that, how's that calculated, or where does that come from?
Generally speaking, they have to give it to you. If you're working out for yourself, like for a business or something like that, usually the rate that you can get from a bank is what you would use as far as determining what the appropriate amount is. But yeah, there actually is quite a bit that goes into how they figured out that discount rate. You can also figure out if you have the total, you can figure out what it is, what the discount rate would be to get to that total. But yeah, it can be a little bit tricky to figure those things out. What was actually being paid out. They call it the internal rate of return would be if you want add an investment. Now these are not actually investments, and they're not investments because there's no negative. The usual way you buy an investment is you pay money, right? And then they send you back the annuities or whatever. And in those situations, you can figure out the internal rate of return. What's it actually making? Is it making 8% or 9% or 12% or what's it making? But those are when you actually pay in and then you get the annuities back. But if there's nothing, you really can't figure out the interest rate unless there is for anything really, unless it's either given to you, or if you want to find the internal rate of return, you can do it, excuse me, based on the based on the internal rate of return, the payout. For most businesses, if you look at your borrowing rate, that's going to be mostly it. If there are some little bit complication of companies that can sell stock, but most companies, especially smaller ones, certainly can't. And so usually if you use the amount that you can borrow money at, that's usually not at least a bad place to start.
All right, that makes sense. Thank you.
Okay, so interest-bearing note, single payment. Okay, so let's see. Field Detergent Company sold merchandise to a customer on June 30, 2027. The payment was made in the form of a non-interest bearing note, resulting I guess requiting is a word, but this should say requiring. You could make if you change that change that one. It's an error. I did spell check this, but I guess requiting is a word. Okay, and so this is they're gonna pay it on June 30th, 2029. I'm gonna make a note. That's 2 years. So this is a 2-year note. Let's try that again. 2-year note. And it's at 10% interest. Okay. And this brings up well, one of the things that we always look at in accounting. I don't have enough room to do this. I don't know. I do. Okay. Substance over form. And substance over form is regardless of the form, what actually was the transaction? And this is going to come up again in the next problem. So substance over form. This is a very important thing that we do in accounting. So the form of this is a note for $100,000. That's the form. It's a $100,000 note. That's all there is on it. There's no interest or anything. Now, we're not stupid. We know that this money in the future is going to be worth less than it is today. And like this 10% interest rate, maybe that's what the bank is charging us. So we can borrow money at 10%. So we're basically giving up, either we have to borrow money for this or we could pay down our loans or whatever at 10% if we got this today. So the question is, is there something else going on here? In other words, is all of this for the merchandise or is some of this for interest? And in this case, it's pretty obvious some of this is going to be for interest. Okay, so let's see what this would look like. We have to discount that 40,000. Is it 40,000? I'm saying crazy numbers, 100,000. It's note receivable. $100,000 times, we're going to see what that's worth today. It's the 2 years, right? So 2027 through, that's 2 years. I'm going to highlight that. Oh, you know, I could highlight them all the way across. Hey, look at that. See? See that? And is that 10%? So this is what we're going to discount this amount at. You know, what's this worth today? Is worth 0.842. By the way, I changed these problems a little bit from the textbook to make them a little bit easier to. So was that 80,000?
Is
84,000.
it 842 or 826?
Oh, did I get it wrong? Oh no, you're right. 826. Sorry. Thank you, thank you. Let's try that again. 826 is so 82,600 then. So this is the value today of that note. So this is really what the sale was today. These are, you know, they took the merchandise today, I assume, it was on June 30th. So this is what, you know, it's not, give me 1 second here. You know, when we make that sale, this is what it is. We really made an $82,600 sale. Now, again, the actual, you know, substance over form, the actual form is that it's a notes receivable for 100,000. But in essence, what we did is we had a sale of 862,600. Now we are going to make interest on this. The interest will be the difference between these two over the next 2 years. We're not gonna do those journal. We could do those journal entries, but we're not going to. So on 630, this is 27. Okay, we're going to have, let's see, they gave us a note. So a note's receivable. A receivable is what kind of a account? Over here we have our list of accounts.
That's an asset.
Yep, and it's going up. Now, in this case, we're going to put it on at the full amount, and I'll show you what we're going to do with the rest of it. Our revenue we're going to have is going to go up by 82,600. So revenues are always credits, basically. Yeah, they're credits. Yeah, unless they go down, but well, for right now, let's say they're for 99.9% of the time they're going to be a credit. And same thing with expenses, 99% of the time they're going to be debits. These are always going up. As the year goes on, you get more revenues and you get more expenses. Okay, so revenues will be 82,600. And I know you're thinking, hey, something's wrong there. We're gonna have a discount on the notes receivable. What else gonna let me? Nope. Oh, I know what I can do. So discounts on notes receivable will be the difference between those two. It's 17.4. I better use Mr. Calculator. Uh, 17,400. So this is 17,400. Now this discount on notes receivable will eventually become interest revenue. Notice it's not revenue from making the sales on this merchandise, it's revenue from interest. And it's considerable. You know, it's 17,000 of this deal is interest. Usually that would mean that would be interest will be broken out separately on the financial statements if they go over a certain amount. If you're wondering, you know, the question is, okay, well, when does this become an issue? It generally becomes an issue at about, for most things, at around the 10% level. And that's just a general level that they kind of throw out there almost for anything. You know, when do you split up between revenues from selling the merchandise from the interest? You know, usually around 10%. But you could all you can still record it separately. It'll just go in a different spot. It won't be part of your main business. Interest income will go with other revenues and expenses if it's less than 10%. If it's more than 10%, you're going to put it at the top of it because now it's a major part of your operations. And so if it is more than 10% of your business is interest revenue, it's going to go at the top of the income statement as normal revenue. And there are some companies that, you know, that's the case. It used to be car companies, they all have their own financing divisions. Those financing divisions were often way more profitable than the company itself. You know, they made more money on the loans than they made on the cars. So those would be, if you look at the car companies, they'd always have financing revenues and financing, you know, income and all that would be in with a regular company because that was a big chunk of their business was that those financing companies. So anyway, yeah. So bringing it up now, there also is a kind of a materiality issue too, as far as how long of a period of time do we wait for our money? If this was a notes receivable, and it was for a month away, you know, we probably wouldn't do much with that. You know, because it's a short period of time. It would be a very small amount. It probably wouldn't make any difference to people reading it. It'd be similar to an accounts receivable. Now, a notes receivable gives you a little bit more legal rights as far as collecting it. A note is just like a check. When you sign a check, it means you will pay that amount. Whoever has that check, they have a right to get that amount from you, and nothing else really matters. If it's a valid check that you wrote and you signed, that means you must pay it. Same thing with a note, which is different than accounts receivable. Accounts receivable, you could, you know, there could be some leeway as far as the goods weren't what we thought they were. There's, you know, back and forth kind of stuff. If it's a signed note, it's a signed note. You collect that amount. So sometimes just to protect themselves, a company will have them sign a note, even if it's not interest bearing and for a short period of time. Okay, so if this is 2 years, 17,000 is quite a bit as far as the percentage of the total. So split it out. Lease payments. Lease payments. This is when you lease something. Now, notice when you lease something, you don't own it. And, you know, so if you're leasing an asset, you don't own that asset. Now you have the right to use the asset for whatever the lease is, but you don't actually own the asset. And for years, this is how companies would avoid putting stuff on their balance sheets. It's not a big problem now as it used to be, what they call off-balance sheet financing. And off-balance sheet financing was companies didn't want to put this huge liability in the books when they buy like an airplane, like this example. They also didn't want to have the asset on the books either. And you say, well, why don't they want the asset on the books? They don't want the asset on the books because it makes a company look less profitable. You know, if you have a ton of assets and your income is little, people look at that and say, man, this is not being run right. This is, this company's not doing very well. Look at all these assets they have, and yet they're only making this little amount of income. So they didn't want the liability on the books. They didn't want the asset on the books either. And so they would go to these leases and they say, okay, it's a lease. We don't own it. It's not ours. We make a payment every year, but it's not ours. And so they would avoid that. Nowadays, we look at substance over form. If any lease is more than a year, you have to do what they call capitalizing it. You have to go through and see what would it be as far as a liability. And then you're also going to put an asset on the books, a leased asset on the books for whatever the amount is. So we look at the substance over form, and signing a 20-year lease is the same as signing a 20-year loan. You're obligated to make these payments, so it should be on the books. Even though technically you don't own it, the form is you don't own it, but you do have this liability and you have the right to use it. Okay, so 20 annual payments at 7% interest rate. Twenty payments of 400,000. Okay. Hey, I didn't put the little table in here. Yeah, we don't need it. Let's do it. Let's grab the numbers. Okay, so the payments are $400,000. And our factor is 20 payments, 7%. This is an annuity. We could do the single payment table, but that would be absolutely no fun because it would be 20 different calculations. So 20 payments at 7%. Okay, so we're down here. So 20 payments at 7%. 10.9, 10.594. Let me double check that to make sure. 10.7%, 20 periods. Okay. So this is what the liability should be on our books, and we're going to have an asset for that on the books too. All right, I got 4 million. Two, 3, 7, 600. So this would be the liability on the books. That's probably not going to fit into our journal entry down here. We'll see. We'll see if I can make it. Okay. Well, let's do the negative part first. We'll do the liability first. Liability will be the lease. Actually, no. Let's do the asset first because the lease is going to be a little bit. Well, it could be a little bit tricky. Let's just put the asset in the book. So the first thing we'll put on the books, we're going to put it on the asset. You put airplane, you put equipment, I guess. This is probably not going to fit. 4. I apologize. Oh, does it fit? Holy cow, it does. All right. Lease obligations. Now, lease obligations, we generally have whenever we have liabilities, we generally split those up between current and long term. Right? We have current ones that are going to be paid in the next year, and then we have long-term ones which are going to be paid in more than a year. So splitting those up, and as time goes on, all the long-term liabilities become current liabilities and then get paid. The question is, when do long-term liabilities get paid? Never, because they have to turn into current liabilities, then they get paid. So as we figured out what goes into current, what goes into long term, we will do it based on what the payments are for the next year will be non-current, scratch that, will be current, and the ones that we aren't going to pay will be non-current. Probably easier just for me to put it on the thing here. Okay, which room do we have anyways? Yeah, we got a little bit of room. Okay, so here's what I'm going to do on this. So I'm going to say, okay, let's see. Okay, wrong button. So this is the total. Lease obligation. Okay, so let's see. I'm going to break this up into lease obligation current. So how much are we going to pay in the next year? Let me ask it differently. How much do we pay every year? Are you guys sleeping? I don't want to wake you. So these are the current yes. Yep, pretty good. Yep, yeah. Yes, Amelia. Yep, you're absolutely right. So the current amount is going to be 400,000. One too far here. So this will be 400,000. And the rest of it's going to be the non-current. And let me see what that's going to be. Yeah. 3,837,000. 600. Okay, so we're going to break these up into these two components. So this will be the short term, will be the 400,000 we're going to pay next year, and then the rest of this will be paid in the future. All right, so coming down here. Lease obligation current. 400,000. And lease obligation. Non-current. It might be hyphenated. The non-current will be 38, 37, 600. So this is breaking those two up into the long and short-term parts of it. And by the way, this leased equipment, you'll depreciate that just like a normal piece of equipment. For European standards, they just use straight line method. US standards, you can use any of the available depreciation amounts. A few differences between, quite honestly, the depreciation, as far as it really doesn't matter. As far, it's not going to change your cash flow or anything like that. So while it is a difference between the European standards and the US standards, it's not, it's a little bit of a timing difference, but it's not usually going to have any impact on, it's not going to have any impact on cash or anything like that. Okay. Oh, so these are so these are the liabilities. They're going up. So it's basically on the books the same as if you bought it. If you bought this equipment, if you bought, what are these airplanes? If you bought these airplanes. Okay, I tell you what, let's stop there and then we'll come back and do the revenue recognition. We're not going to finish this, I don't think. We'll see. Okay, so let's see, stop. Oh, no, not stop, be back. I'm sorry. Don't say, hey, let's just stop. Be back at, what is it, 248? Let's just say 3. How about that? I'll make it easy. So be back at 3. I'll kind of leave this up. You know what? I'm going to put it up here. Okay. Okay, let's see. Chapter 6 is about revenue recognition. Revenue recognition is a big issue now. Revenue recognition is a big issue now. No, maybe it's like 10 years ago or so, they really started to look into it and get a little more serious about how we actually recognize revenue. When do we do it? What methods do we use? It was a little bit, well, in the past, it was always just systematic and rational. It was an allocation, and now they've defined it a little bit better. A lot of it is exactly the same. And, generally you recognize revenue when it's earned. And so the question is, when is it earned? When have you done your part of the deal? So if you just sign a contract or something like that, you don't recognize that as a revenue. Not until excuse me, some parts of that contract have been fulfilled. And in sales contracts, we actually deal with them every day. Even though you don't know it, if you go to like a store, a grocery store, there's a sales contract. When you take something up to the cash register, whatever the price was marked at, you are offering to buy that at that price. Now, the price is different. We've all been there. Okay, this is supposed to be $2 and now it's $3 or it's whatever. Then that is a counter offer from the cashier to you. Oh, this is, these aren't the ones that are on sale. These are actually $4. They're not $2 or whatever. That's a counter offer. And at some point, you either say, I don't want that, you're rejecting their offer, or you say, okay, yeah, sure. Then it's a meeting of the minds, it's a contract, and you pay for it. So this is all contract, law. And people say, well, wait, if I put it in the cart, is it, I put it in because of this, that was me accepting their offer to sell it at that. But again, if that were the case, that would mean you can't take anything out of your cart. If the second you put it in the cart, it was the contract, that means that's the contract. So it is a kind of a, even though we deal with it every day, it's not really something that we, you necessarily recognize. So contracts, such as sales contracts for revenue, they have them all the time. They're just not, for the most part, they're pretty much, everyone knows pretty much the rules on them. There is something, we do have a false advertising laws in states, so sometimes you can run into that where they have it on the shelf at a certain price and then it's not the same at the register. But as far as the contract law is concerned, it's when you're at the cash register that you actually run into that. Okay. Revenue recognition. So this is especially true in things like long-term contract. Oops, what am I doing here? Okay. So let's take 6.2. You can get a lift ticket for $85, or they can purchase a season pass that entitles the holder to ski any day during the season, which typically runs blah blah blah. Coming year in, okay. Jake Lawson purchased a season pass for $450 on November 1st. Okay. So November 1st, apparently Jake is planning on skiing in December through April. Well, a season pass for $450, and the question is, how do we account for that? Now, notice on November 1st, we really haven't earned anything. I mean, Jake isn't skiing there. He can't ski there for another month or whatever. But we have Jake's money. So Jake sent us the money, $450. Okay, so coming down here, what are we going to do with Jake's $450? the $450 he sent us. And he really did send it to us on 11/6, so we have to account for it. So Jake sent us, let's assume it's a check. He sent us a check for $450. What asset is this going to be?
Could it be accounts receivable?
Actually, he's already paid it. So this is just going to be
Sales
cash.
revenue? Oh, just cash.
Right now it's just cash because we haven't earned any of it. So we're going to first put it in as just cash. Oops, that's not how you spell cash. 1 second here. So cash, it's an asset going up. I don't think I need to put that in. I guess I could. You don't need to put this in. I'm just falling back into teacher mode. Okay, so 450. So we're recording the cash that, yeah. Now we haven't earned any of this revenue yet. Jake hasn't come. He can't come. He can't come until December 1st. So this is going to be deferred revenue. The old term was unearned revenue. And for some reason, we changed that to deferred revenue, and this is a liability. Yeah, I know, I could do this. The liability going up. We'll make cash into yellow. That looks beautiful. Okay, so this is what we're going to first put on the book. So it's deferred revenue. This is sort of like unearned revenue in the past. It's revenue, but we can't count it. We haven't done anything. And notice that if we shut down the resort or whatever, that we have to give, what's this guy? Jake, we have to give Jake his money back. So we have a liability here because we haven't done anything for Jake yet. Okay, so when should the ski West recognize revenue from the season pass? One of the easier ways to do it is if it's for a period of time is just to break up how many periods of time we have. So this is, I'm going to do something. So the ski season is between December 1st and April 30th. So this is 1 month, 2 months, 3 months, 4 months, and 6 months. No, I'm kidding. It's 5. Okay. So the question is, how much do we recognize each month? We would simply take the 450 and do what? Season pass is 450. And we're going to divide it by 5 months. Oops. And that's going to equal $90 per month. So this is how much revenue we're going to recognize in each of these months. So we're going to recognize 90 of it in December. I don't know why I did it this way. But every month we're going to recognize $90 of revenue. Okay, so coming down to this, do I even have enough room anymore? I'm messing this up. Okay, it's at the end of December. We've earned $90 of this revenue. So we're going to take off the deferred revenue. Oops. For $90, and it's going to become just plain old revenue. So as we earn this deferred revenue, it's going to come out of deferred revenue. It's no longer a liability. We've given Jake a month worth of skiing. So we're going to recognize how much of that revenue we've earned. We've earned 1 month worth of it. And so eventually the entire 450 will come off at $90 a month. If you do it every month, you may do it in a lump sum at the end of the 4 months or something, but so we're going to recognize revenue of $90 on December 31st. Okay, so coming down here, how would this be shown in the income statement and balance sheet? What would we show on the income statement for this? So here's the income statement. How much revenue are we going to show?
$90.
Yep. So revenues for this would show as 90. As far as assets are concerned, now we did get the cash at some point in there. So, I guess somewhere in the cash, whether it's still there or not, is the 450. Yeah, I know whether it might be spent by now. But from the previous from 9/6, or excuse me, 11/6, that 450 will be in there. Now at year end, though, the liabilities, how much do we still have in deferred revenue? So we still owe Jake some services here.
You would have 360 left.
Yep. And I think I ran out of space here at some point. So the deferred revenue, I'm going to change this to black. I just want to show something. So deferred revenue would be, yeah, we had 450 in there. We recognized 90 of it. We took 90 out, so it'll still be 360 in there. And green. And let me put the calcs in that. Yeah, it makes it more confusing. Okay, so now if you're wondering, look, okay, that if we here's all the stuff, the balance sheet isn't going to balance. Now remember, this revenue is going to end up being an income, And this income, from income, it's going to go into the equity section. So this 90 will actually show up over here. So if you're wondering, gee, how does the balance sheet balance? Well, we got cash of 450 at some point. This 90 is going to show up in our income, and the income is going to go be changed, going to be put into retained earnings. I need more room. There we go. Got it. Oop. Okay. So in our equity section, we're going to have retained earnings. And somewhere in those retained earnings, this $90 is going to be. We're going to, close the account over to the retained earnings, and it'll be that $90 will end up in those. Yeah, the $90 will end up in those retained earnings. So that's how the balance sheet balances. We have 450 cash. We have deferred revenues of 360. We still owe. The owners have earned 90 of it, and so this is why everything balances. Okay, I'll put another arrow in there. Any question on that? Now, truthfully, I mean, if your journal entries balance, this is going to balance. Even if this is incorrect, it'll still balance. You put in the wrong account, it'll still balance. But I mean, as long as your debits equal your credits, you're going to get something on it. But this is kind of how it goes about, though, that 90 in revenues will end up going into retained earnings, and that will be the total. Question on that? Okay, let's go to E6-12. By the way, basically the rules that were kind of replaced. We only used to have three rules basically in revenue, and they would be that it's earned, that it's realized or realizable. In other words, it could be that they paid cash, realized, or realizable in the form of like accounts receivable or notes receivable. And then the third one is that it's collectible, that whoever you sold it to will be able to pay for it. And if those three were met, that was it. Now it's a little bit more involved. They have a few different methods, but those still pretty much hold true though. And if you ever are questioning whether it's a real, what the transaction is, the big thing to go back to is, was it earned? Have we done our part? Okay. Arctic Cat sold Seneca Snow Sports a shipment of snowmobiles. Snowmobiles were delivered on January 1st, 2027. By the way, especially you guys maybe already do this, but the dates are usually important, especially you get to the CPA exam or something like that. Make sure you look at the dates, what they actually are. We'll pay $40,000 on December 31st, 2027. Unless informed otherwise, assume our market views the time money component arrangement to be. I don't know why they put that in there. Like Arctic Cat's going to call us up. The interest rate is 8%. Determine revenue is recognized from the foot. This is the same things we did before. All right. So how many periods?
Would it just be one year?
Yep, one period. Yep, beginning of January 2027 to the end, 1 year. So our one period, interest rate is 8%. Ooh, let's try that again. Okay, 8%. So we're gonna take the 40,000 note. So each one of those $40,000 is going to be worth 0.926. $37,040. Which one do I have? We got a space here, I think. Make the journal entry on January 1st. Okay, so what would the journal entry be? Now, they didn't give us cash. They gave us this note.
Would be a note payable or an account receivable?
Yeah, probably be a note receivable. It's gonna be a receivable, so that's gonna be the asset. How do I make the assets up here? Yellow. Okay, keep with that. So notes receivable, so they owe us the note receivable. It's a $40,000 note. So the form is a $40,000 note. So we're gonna put that in here. And down here, we're gonna have well, the revenue recognized will be turquoise. The hard part about accounting, color coordinating all these. All right, so revenue will be 37,040. Receivable an asset. Hey. I'll leave it. Oh, maybe, maybe I can move this over a little. Will that help? Okay. A little wiggling around there. All right, and we don't have this thing balancing. We need $2,960 to make this balance. Oops. And this is going to be, I think we already did this one, didn't we? Discount on notes receivable. This is going to reduce our notes receivable by, well, this one's going to be different. Oops. So it's going to reduce our notes receivable by, this will actually be an asset going down. This is a contra account. It's going to reduce our notes receivable by some amount. And we'll make it dark right now. Question on this one? So here's what this will be showing on the balance sheet on January 1st. If we made a balance sheet on January 1st, it would show notes receivable of 40,000 minus 2,960. So it would show this as our actual notes receivable. We hadn't earned any interest by that point. Okay, assume the same facts. Requirement 1, repair the journal entry. Okay, so what's this? Seneca. So Seneca is sending us a check for, oops, 40,000. Collection of the payment. Okay, so cash. Is that going up? Okay, now we actually have to take an asset off our books. What is it? Since they paid this,
Would it just be like an account pay? Well, it wouldn't be an account payable, but
no, you're right. It's yeah, yes, yep. Vanessa, yeah, it'd be the notes receivable. So this asset, now notice that we had to sign it as an asset because they owe it to us, but now they just paid us. So now we have to take it off the books. And I know this is going to get messed up, but I don't care. So we're going to take it off the books to 40,000 because they no longer owe us this anymore. Come on, you. My dogs are barking at the neighbors right now. And humorously, I got these little tiny dogs, and the neighbors have absolutely giant dogs. They got a Malamute that looks like a bear. And when it stands up, the neighbor's dog, when it stands up, it literally looks me in the eye. I mean, it's like, it goes over the fence, it's got this huge head, and it looks just like a giant bear. Like, anyway, I got these little dogs that yap at it and bother it. But luckily, the Malamute doesn't care. I don't even know if the Malamute knows that they're dogs. It probably thinks they're squirrels or something. Okay, now this discount on notes receivable. Okay, this is really due to the interest, right? So this is going to be taken off our books. And this will turn into interest revenue. You could actually calculate that too. 8%. $3,740 times 0.08 should come out to something pretty close to that. May not be exact, but it's off a little bit. Did I do that right? Yeah, it's off a little bit because of rounding. This comes out to 29.63 and 20 cents. Let me fix that. So if you actually do the calculations, it's up by $3, something like that. You know that this is what you're actually having the interest on. Pretty close, and that would have to do with this. That these aren't round. These are rounded. If you were to have these out more decimal places, this would have been a more exact number. But it's pretty close. Okay. All right. This is one that, how do we split up the costs of each of these? Okay, so Video Planet, they sells, they sell this. Hey, this is sells a big screen TV package consisting of a 60-inch plasma TV. Do they even make those anymore? I don't know. A universal remote and a on-site installation by VP staff. Programming, blah blah blah. The entire package sells for $1,900. TV concludes that the TV, the remote, and the installation are separate performance obligations. So they're separate. We need to break them out separately. Okay, so the TV separately sells for 1,700, the remote for another 100, and the installation service for 200. Okay, so these are what they call the standalone prices for each of them. So the question is, how much revenue do we give to each one of those? Because if we add these up, and obviously this is a, oops. $2,000. Okay, there's a few different ways we could do this. We could go through each one and determine what percentage it is of the total. and then multiply that by, to come up with these. How much is the total of this 1900? There actually is a quicker way to do it. And the quicker way to do it is just to divide the package by the standalone prices. Not sure where I want to do that. We'll do it here. So what we're going to do is get a ratio of the TV package and we're going to divide that by the standalone total. And we're going to go out one more. All right. So that comes out to 0.95 or 95%. I'm just going to keep it at 0.95. So all we need to do is multiply all of these down here by 0.95. And this will give us how much we're going to have for each of those. That coming up. So 16, 15. Oops. It does come out. Oops. And so that's a standalone up there. And these would be the allocated. Okay, I don't think, I changed this one, and that's why this one looks. Record the entry for the above transaction. You say there is no above transaction. Let me change this. Let's say the sale of one package. I'll put it underneath, I guess. So add this to it. I thought I had this all worked out. No, I say that every time, but. So let's say for the sale of one TV package, what would we have? It looked like this. I don't even give a date on it. Let you guys pick a date. What date do you want? Could be any date. Could be your birthday. Could be your dog's birthday.
August 25th.
August 25th. Good date. August 25th. Now, is that your birthday? It is. You got 2 days. No, it's already passed. Never mind. All right. See, okay. So there's be cash asset going up. $1,900. And then we're going to allocate these out to the different revenues. So revenue TVs would be 1615. Revenue, I don't know if it's remote or accessories. I'm going to say remotes. Could be accessories. It could be whatever they. And revenues. What is it? Revenue. Installation. Now, actually, you may say, okay, well, this is fine. They're splitting it up. But does it really matter? Actually, usually things like installation don't have a sales tax on it. They can, but oftentimes they don't. So it is possible that this actually has a dollar impact on your taxes. Tax you have to collect. So this would be revenues. And two, so each of these, and these may be very different or things in the organization too. The people who do the installations are going to be different than the people who are selling the TVs and so on. And you want to kind of break them out to see, make sure that, which one, for profitability and all that, to track how the company's doing, and, splitting these up probably makes a lot of sense. Just from a control standpoint. So this is allocated, again, this is based on the standalone prices. And I think I'm going to stop here. Yeah, I'm going to stop here because we got to do a little bit something different on this next one. The next one is what if they can't find a standalone price? Well, we'll stop here. That one's going to take a little while. Okay, so now, we do have the, excuse me, the exam. Oh, first of all, any questions on this one? There's other ways to do it. This is probably the fastest way. I used to show it the book way, and I had a student about 15 years ago that said, "Can we just do this?" And I was like, "Yeah, that's a lot easier. It's a lot quicker." But anyway, yeah,
I guess the TV package saves them 5%.
yeah,
Yeah. Okay.
yeah. That's exactly it. And the book will show you to break these up into a percentage for each one, and then use that percentage from each one to multiply by the 1900. So, for instance, 1700 divided by 2000 would be, what is that? 85%. I don't know. I think it's like 85%. So you take 85% of 1900. And if you take 85% of 1900, it should come out to this. Now that I said that out loud, I'm going to make sure I didn't just tell you something stupid. 0.85 times 1900. Yeah. 85% times 1900 will give you the same thing. But you have to do basically 3 calculations instead of 1. You have to do a calculation. You have to do this calculation for all 3 of them. Because this will be whatever they are, the standalone price over the standalone total for each one. 3 different, whereas you can just do if you just get the 195%, you can just multiply that. So it's a little bit quicker. I guess for 3, it probably doesn't matter too much, but you can imagine if this was a more complex one that had, many more parts to it, it would definitely be easier just to do it this way. Okay, so let's stop here. We'll finish this up next class, and we might do some additional ones, or I may just I'll have to take a look. I'll have to take a look. There is a I'll have to look and see if it, for instance, the long-term contracts and things like that, if we're going to do those. Yeah. So, but anyway, long story short, let's just stop here, and then next class we'll finish it.
Professor, can I stay a few after and ask you about a question I had about the test?
Sure can. Yep.
Thank you.
Okay. Any questions? Okay. See you.
Thank you, Professor. Have a good one.
I will. You
Thank you,
too.
Professor.